There is a moment in history, and it repeats itself more often than people realize, when the cost of living quietly outpaces the ability of ordinary families to keep up. It does not happen overnight. It creeps in slowly, like water rising in a room where the doors are sealed shut. You notice it first at the grocery store, then at the gas pump, then in the utility bill, then in the rent. And by the time most people recognize what is happening, the water is already at their waist. We are at one of those moments right now. Inflation, the force that erodes the purchasing power of money, the force that over time favors owners of real and adaptable assets over holders of fixed nominal savings, has not been defeated. It has been slowed, partially for now. But the conditions that sustain inflation, the deep structural conditions embedded in government balance sheets, central bank mandates, global trade architecture, and demographic shifts have not been resolved. They have been managed temporarily. And if you study history carefully, you begin to see a pattern that is difficult to ignore. Inflation has returned before, precisely when people believed the worst was behind them. It happened in the late 1940s. It happened throughout the 1970s. Versions of it have played out across centuries of recorded economic history. This video is not designed to frighten you. Fear is not a useful tool, understanding is. What I want to give you today is a clear, calm, rational framework, the kind of first principles thinking that turns a complex and threatening subject into something you can actually navigate. We will look at what inflation really is at its root. We will trace its historical patterns. We will examine the structural forces building beneath the surface right now. And then, most importantly, we will talk about what families approaching or living in retirement can do to position themselves more intelligently, because the families who prepare do not merely survive inflationary periods. They tend to emerge from them in a fundamentally stronger position than those who are not paying attention. Stay with me through this conversation. The framework we build in the early sections is what makes the practical guidance at the end genuinely useful, rather than just a list of things to do. Most people think of inflation as prices going up. That is technically correct. But it is like describing a wildfire as things getting warm. Accurate, but missing everything that matters. To understand inflation at a root level, you need to understand what money actually is. Money is not wealth. Money is a claim on wealth. It is a ticket. When you hold a dollar bill, you hold a ticket that says someone owes me a certain quantity of goods or services. Now imagine a concert with 1,000 seats and 1,000 tickets. Each ticket is worth exactly one seat. But suppose someone prints 2,000 tickets while the number of seats remains the same. Suddenly, each ticket is worth half a seat. The tickets look identical. They feel the same in your hand. But their real purchasing power has been cut in half. That is the essential mechanism of inflation. It is what tends to occur when the total quantity of money and credit in an economy grows meaningfully faster than the quantity of real goods and services that money can buy. But here is where careful thinking becomes important. Inflation is not a simple single-cause phenomenon. It is a system with multiple inputs that interact and reinforce one another. Monetary expansion by central banks is one critical driver. When the supply of money and credit grows rapidly, more currency is chasing the same pool of goods. Fiscal deficits are another. When governments spend significantly more than they collect in taxes, that additional spending adds demand to the economy. If supply cannot grow fast enough to meet that demand, prices rise. Supply constraints matter too. Broken supply chains, energy shocks, or geopolitical disruptions can reduce the availability of goods, pushing prices up even without any change in the money supply. Inflation expectations are a third force that can take on a life of their own. When workers and businesses expect prices to keep rising, they adjust wages and pricing decisions accordingly, And in doing so, they can validate and extend the very inflation they were anticipating, and labor costs play a role. When wages rise faster than productivity, whether due to tight labor markets, demographic shifts, or structural changes in the workforce, those higher costs filter through into prices across the economy. Short term price spikes, a drought that drives up food prices, an oil embargo that lifts energy costs, a pandemic that fractures supply chains can absolutely ignite inflationary pressures that are real and significant. These triggers deserve serious attention, not dismissal. But the distinction worth understanding is this: sustained structural inflation, the kind that persists for years and reshapes an entire economy, almost always involves several of these forces operating simultaneously and reinforcing one another. When that happens, it is rarely resolved quickly or painlessly. Here is the synthesis worth carrying through everything that follows. Inflation is ultimately the consequence of claims on real goods and services growing faster than the real goods and services themselves. Everything else, the fiscal deficits, the monetary expansion, the supply shocks, the expectation spirals, is a variation on that single underlying imbalance. Once you see it that way, the historical patterns stop being surprising. If you zoom out far enough, one of the most consistent patterns across economic history is this: governments tend to spend more than they collect in taxes over extended periods. They do this because the needs of citizens reliably exceed available resources, because wars, crises, and recessions arrive without warning, because the political incentive to spend is almost always stronger than the political incentive to save. When governments face that structural gap, they historically have had three broad tools. They can borrow, issuing debt that must eventually be serviced and repaid. They can tax, politically painful and often practically limited. Or they can inflate, either by directly expanding the money supply or by maintaining conditions where real interest rates stay low enough that inflation gradually erodes the real burden of existing debt. History also shows that governments have reduced sovereign debt burdens through financial repression, deliberately keeping interest rates below inflation to make the real cost of borrowing negative over time, through selective restructuring, through growth spurts that expand the tax base relative to debt, and through explicit inflation. No single mechanism is inevitable, but each has precedent, and their common thread is that the burden of adjustment tends to fall, in most historical episodes, on the holders of fixed value financial claims, those whose wealth is stored in instruments that promise a fixed nominal return. After World War II, the United States carried a debt to GDP ratio that had reached extraordinary levels during the war. Rather than imposing severe austerity, policymakers allowed inflation to run at meaningfully elevated levels through the late 1940s, in some years reaching 6 to 8%, while interest rates on government bonds were kept suppressed through a formal agreement between the Treasury and the Federal Reserve. This combination, elevated inflation alongside controlled interest rates, is a textbook example of financial repression. It helped reduce the real burden of war debt without formal default. It also significantly eroded the savings of families who held their wealth in cash and fixed income instruments. The lesson is not that the government deliberately set out to punish savers. The lesson is that when the pressure of large sovereign debts meets the political difficulty of austerity, the adjustment often involves some combination of inflation, low real rates, and financial repression, whether by explicit design or by the accumulated weight of policy choices made under pressure. The most instructive recent example for Americans is the period from roughly 1965 to 1982. The conditions were, in hindsight, predictable in their interaction. The Federal Reserve, under pressure from successive administrations, maintained an accommodative monetary policy for too long, keeping interest rates below the level needed to restrain credit growth. This was not simply a matter of printing money directly. It was a sustained pattern of monetary accommodation that allowed credit and demand to expand faster than the productive capacity of the economy. At the same time, federal spending expanded substantially on the Vietnam War abroad and large social programs at home, creating fiscal deficits that added demand side pressure to an already stretched economy. Then came the oil shocks of 1973 and 1979. These were supply side events, sudden, sharp reductions in oil availability that raised energy costs across the entire economy. They did not cause the inflation on their own, but they collided with the existing monetary and fiscal environment and dramatically accelerated it. The combination proved devastating. By 1980, the United States was experiencing annual inflation rates above 13%. Consumer prices roughly doubled over the decade of the 1970s. Families on fixed incomes, retirees, pensioners, those living off savings accumulated over decades of careful work saw the real purchasing power of their wealth erode significantly and persistently. The Federal Reserve under Paul Volcker eventually broke inflation's back, but only by raising interest rates to levels that caused two painful recessions and years of high unemployment. It was one of the most costly economic corrections in modern American history. Most people who lived through that period assumed it could never happen again. The Fed had learned its lesson. And for roughly 40 years, through the long disinflationary era from the mid 1980s through 2019, that assumption held. Financial plans were built on it, retirement strategies assumed it. An entire generation of savers internalized the idea that low, stable inflation was the durable norm. Then came 2020. If you are thinking, but we already beat inflation, the Fed raised rates and it came back down. That is partially true. And it is exactly the kind of thinking I want to examine carefully now, because the structural story is more complicated than the headline numbers suggest. When the pandemic arrived, governments and central banks around the world made a historic choice. It was, in many respects, a defensible choice in the moment. Facing economies in free fall, workers unable to work, businesses shuttered, supply chains fractured, the United States government deployed trillions of dollars in fiscal support, stimulus payments, forgivable business loans, enhanced unemployment benefits. Simultaneously, the Federal Reserve cut interest rates to near zero and launched an aggressive program of asset purchases, buying treasury bonds and mortgage-backed securities to suppress interest rates across the economy and maintain market functioning. This program is commonly called quantitative easing. The result was a significant and rapid expansion of the money supply and credit between early 2020 and early 2022. The M2 money supply, a broad measure of money in circulation, expanded by roughly 40%. That is an extraordinary rate of expansion over an extremely short period. Remember the concert analogy. The seats, the actual goods and services available in the economy, did not grow by 40%. Supply chains were broken. Factories were shut. Workforces were disrupted. In many sectors, the supply of goods actually contracted. So what you had was dramatically more money and credit chasing a supply base that was simultaneously constrained. The result was entirely consistent with what the historical pattern would predict. Inflation surged. By June 2022, the Consumer Price Index was rising at 9.1% annually, the highest rate the United States had recorded since the early 1980s. Across groceries, gasoline, housing, and healthcare, prices rose sharply and broadly. The Federal Reserve responded by raising interest rates at one of the fastest paces in its history. And inflation did moderate significantly from that 2022 peak, a meaningful improvement that reflected real policy effectiveness. Many people breathed a sigh of relief. We're through the worst of it, the narrative went. The Fed did its job, but here is where careful first principles observation becomes essential. The surface numbers improved. The structural conditions underneath them did not. And if you understand those structural conditions, the deep, slow moving forces that don't appear in monthly CPI reports, you begin to see why the risk of another inflationary surge remains meaningfully elevated. The United States federal debt is now approaching $39 trillion. To put that trajectory in perspective, it took the country its entire first 2 centuries, from 1776 through roughly 2000, to accumulate its first $6 trillion of debt. The pace of accumulation has accelerated dramatically in the decades since. Annual net interest costs are nearing $1 trillion and are projected to exceed that threshold in 2026, placing interest payments among the fastest growing categories in the federal budget, competing directly with defense, Medicare, and Social Security for fiscal space. This creates a structural constraint that did not exist in previous inflationary episodes in quite the same way. When debt reaches this scale, the traditional policy responses, meaningful spending cuts, or significant tax increases, face enormous political resistance. The arithmetic of servicing the debt also begins to shape what the central bank can realistically do, which brings us to a dynamic that economists call fiscal dominance. Fiscal dominance describes a situation where a government's debt burden begins to limit the central bank's ability to raise interest rates as aggressively as inflation control would otherwise require. The higher rates go, the faster interest costs rise on trillions in outstanding debt, and at some point that cost becomes politically and fiscally unsustainable long before inflation is fully contained. This does not mean the Federal Reserve loses its formal independence. It means the practical range of policy options may be narrower than it was in earlier inflationary cycles, and that narrowing is a direct consequence of the debt trajectory. Cause and effect playing out over the long cycle. The second structural driver is deglobalization. For 3 decades, global trade was one of the most powerful deflationary forces in the world economy. The ability to manufacture goods in lower cost countries and ship them efficiently to consumers everywhere put consistent downward pressure on prices. American consumers benefited enormously and largely invisibly from this dynamic. That era is not ending all at once, but it is reversing at the margin. Geopolitical tensions between the United States and China, covering semiconductors, critical minerals, and strategic manufacturing, are driving a reassessment of supply chains that depend on foreign production. Trade barriers, tariffs, and reshoring initiatives are expanding across both political parties. When production moves to higher wage environments, production costs rise. Those costs eventually pass through to consumer prices. Deglobalization is, at the margin, inflationary, and the trend appears durable regardless of near term political changes. The third driver is energy transition costs. The structural shift away from fossil fuels toward renewable energy sources is, over the very long arc of decades, likely to produce significant efficiency gains and potentially lower energy costs. But in the medium term, over the next 10 to 20 years, the transition itself creates inflationary pressure. Building new energy infrastructure at scale is capital intensive. Retiring existing infrastructure before it reaches natural end of life creates supply gaps. The metals and minerals required for batteries, solar panels, and electric vehicles, copper, lithium, cobalt, nickel, are relatively scarce, subject to geopolitical supply risk, and experiencing demand growth that the mining industry is not yet able to fully meet. Since energy costs underpin the production and transportation of virtually everything, sustained uncertainty and elevation in energy prices make structural inflation harder to control. The fourth driver is demographic shifts. For decades, the global labor force expanded rapidly, driven by the baby boom generation entering peak productivity years, and by the integration of hundreds of millions of workers in China, India, Eastern Europe, and elsewhere into the global economy. A large, growing workforce tends to be deflationary. More workers mean more production, more competition for jobs, and sustained downward pressure on wages relative to productivity. That dynamic is now reversing. Baby boomers are retiring in massive numbers, withdrawing from production while increasing demand on healthcare and social support systems. Birth rates across most developed economies are at or near historic lows. The large labor pools that powered manufacturing growth in the developing world are themselves aging. Fewer available workers relative to the demand for labor puts upward pressure on wages. Higher wages raise production costs. Those costs filter through to prices. The demographic shift is structural, slow moving, and not easily reversible on any near term policy timeline. The fifth driver is the most behavioral and, in some ways, the most powerful. Inflation expectations, once they become embedded in how workers negotiate wages and how businesses set prices, can sustain and amplify inflation well beyond what monetary conditions alone would produce. When workers expect prices to rise by 5% next year, they seek wage increases of 6 or 7% to protect their standard of living. When businesses expect input costs to keep rising, they build pricing cushions into their forward projections. When consumers expect prices to be higher next month, they accelerate purchases today, adding to current demand. Each of these behaviors is individually rational. Together, they can validate and perpetuate an inflation regime that becomes progressively harder to dislodge without significant economic disruption. The Federal Reserve works hard to keep long run inflation expectations anchored. And it largely succeeded after the 2021 2022 surge. But anchoring expectations requires maintaining credibility, and that credibility becomes more difficult to sustain if structural conditions limit how aggressively the central bank can act. Let me make this concrete. Consider a couple in their early 60s. They have done everything that conventional financial wisdom told them to do. They worked steadily for 40 years. They maxed out retirement contributions whenever they could. They lived modestly. They avoided unnecessary debt. They built a portfolio weighted toward bonds and cash because that is what conservative, responsible savers were told to do as they approached retirement. Their plan rests on a quiet assumption that the money they saved in their 50s will buy roughly the same amount in their 70s and 80s. That assumption feels solid. It always has before. Now consider what happens if inflation averages 5% per year over the next decade. Not a hyperinflation scenario, not a collapse, just a sustained return to the kind of inflation that characterized much of the 1970s. At 5% annual inflation, the general price level roughly doubles over 14 years. A grocery bill that runs $700 a month becomes $1,400. A utility bill that runs $250 becomes $500. Healthcare, already the single largest and fastest growing expense for most retirees, rises substantially faster than the general price level as it historically has. Meanwhile, the couple's bond portfolio and cash savings, if earning 3 or 4% annually in a 5% inflation environment, are losing ground in real terms every single year. The nominal numbers in their accounts stay the same or grow modestly, but what those numbers can actually purchase declines steadily. Over a decade, the cumulative erosion of purchasing power in a fixed income heavy portfolio during a sustained inflationary period can be substantial, not catastrophic in the way a market crash is visible and dramatic, but persistent and compounding in ways that quietly reshape what a retirement can look like. Nobody stole their money. There was no fraud, no market crash, no single catastrophic event. What happened was more precise than that. The fixed nominal value of their savings held steady, while the real goods and services those savings could command were gradually diminished by an economy running hotter than their portfolio was designed to handle. Here is the painful irony that history reveals repeatedly. The families who get hurt most by inflation are often the ones who were most careful, most responsible, most financially conservative. Because inflation erodes the real value of fixed nominal claims most directly, and those are precisely the instruments that disciplined, responsibility minded savers tend to favor. Meanwhile, those with significant real assets, real estate, businesses, equities in companies with strong pricing power, commodities tend to preserve and sometimes grow their wealth during inflationary periods because the nominal value of real assets tends to rise with the general price level. Inflation is fundamentally a redistribution mechanism. Understanding where you sit in that redistribution is the first step toward doing something about it. We are now halfway through this framework. Everything we have covered, the causes, the history, the structural drivers, the human impact, exists to make the next section genuinely useful. Because practical guidance without analytical grounding is just noise. Let's keep going. Let me pull back to the longest possible time horizon. Throughout history, and this pattern appears with notable consistency across different cultures, different monetary systems, and different eras, there have been long periods of relative monetary stability, followed by periods of monetary disorder and adjustment. These cycles tend to follow a recognizable arc. A dominant economic power builds prosperity through productivity, growth, innovation, and expanding trade networks. Over time, the costs of maintaining that dominance grow militarily, socially, institutionally. The gap between income and expenditure widens, debt accumulates. The currency is gradually debased in ancient empires by reducing the precious metal content of coins. In modern economies, by expanding the money supply relative to productive output. Inflation tends to rise during these periods. Trust in the currency erodes at the margin. The long run equilibrium tends to reassert itself, sometimes gradually, sometimes more abruptly, depending on how far imbalances have extended and how resilient the underlying economy remains. By most careful measures, the United States appears to be navigating a later stage of the current long-term debt cycle. That does not mean crisis is imminent or that collapse is the likely outcome. These cycles can extend far longer than observers expect, particularly for economies with genuine structural strengths, and the United States has real and significant ones. Deep capital markets, an innovation ecosystem without global peer, rule of law traditions, a reserve currency with no near-term credible replacement, a military capability that remains dominant. These advantages are meaningful. They create resilience and extend the timeline, but they moderate and delay structural adjustments. They do not cancel them. The question most worth asking, then, is not a forecast about timing. The more useful question, the one that leads to action, is how should a family positioned with most of its wealth in fixed nominal assets navigate a period where those assets may face significant and sustained headwinds? That is the question we turn to now. I want to be clear about what I am and am not saying. I am not predicting that inflation will return to 9%. I am not predicting that the dollar will collapse or that the bond market will break or that any specific crisis is imminent. What I am saying, based on the structural analysis above, is that the probability distribution of inflation outcomes over the next decade is skewed toward the upside in a way that is not fully reflected in conventional financial planning assumptions. Here is the scenario worth thinking through carefully. Suppose the business cycle turns as it periodically does. Growth slows, unemployment begins to rise, political and economic pressure builds for the Federal Reserve to ease monetary conditions. The Fed cuts interest rates. The government, facing an election or a genuine economic downturn, passes additional fiscal support measures. Fiscal deficits widen. At the same time, the five structural drivers we discussed continue building their slow moving pressure. Deglobalization raises production costs, demographic shifts tighten labor markets, energy transition spending adds to input costs, and expectations, once they begin shifting, can accelerate faster than policy can respond. Inflation, which moderated significantly but may not have been structurally resolved, begins reaccelerating. Now the Federal Reserve faces a genuine dilemma: raise rates aggressively again, but with the federal debt approaching $39 trillion, interest costs already nearing $1 trillion annually and projected to exceed that in 2026, could escalate rapidly, creating serious fiscal pressure. Or tolerate elevated inflation, accepting a period where prices rise faster than the Fed's 2% target in order to avoid the economic pain of aggressive tightening. Historically, when governments face this specific trade off, short term economic pain from tight money versus longer term erosion from elevated inflation, they have often leaned toward tolerance, not because they preferred inflation, but because the political and economic costs of the alternative were more immediately visible and painful. The result, when this dynamic is played out, has sometimes been what economists call stagflation, an environment where price pressures remain elevated even as economic growth slows and job security erodes. For families approaching or living in retirement, stagflation is among the most difficult economic environments to navigate. Growth is slow, asset returns are uncertain, but living costs keep rising. Again, this is not a forecast, it is a logical consequence analysis. The architecture of risk has shifted in a direction that conservative, responsible savers need to take seriously. Let's bring this directly to the situation of families who are approaching or living in retirement. Here are the specific channels through which a sustained return of inflation would affect your financial life. Money held in savings accounts or money market funds earning 2 to 3% annually in a 5% inflation environment is losing purchasing power in real terms every year. The nominal balance grows, the real value declines. This is not a dramatic crisis. It is a slow, persistent drag, but compounded over a decade or two of retirement, the cumulative effect on what your savings can actually support is significant. Bonds, historically the anchor of conservative retirement portfolios, face two distinct headwinds in inflationary environments. First, rising interest rates depress the market value of existing bonds. If you hold bonds to maturity, you recover principal, but you hold an asset earning a below inflation coupon for its full duration. Second, even if the bond holds its nominal value, its real purchasing power at maturity is lower than it was at issuance. A 10-year bond bought in a low inflation environment and redeemed in a higher inflation environment returns less real wealth than the original investment held. Healthcare has historically inflated faster than the general CPI, even in periods of moderate overall inflation. For retirees who tend to spend a disproportionately high share of income on healthcare, this means that inflation hits them harder than the headline numbers suggest. Social Security's cost of living adjustments, which are based on a general basket of consumer goods, may structurally undercompensate retirees whose actual spending patterns are more healthcare intensive. If you own your home outright, real estate has historically served as a reasonable store of value during inflationary periods. Nominal values tend to rise with the general price level over time. However, property taxes rise with home values. Maintenance and renovation costs rise with broader construction inflation. And for the significant portion of retirees who rent, housing costs can escalate rapidly in a high inflation environment. Social Security does provide cost of living adjustments. That is meaningful protection, and it is one of the most underappreciated features of the program for inflation purposes. But the formula may not fully capture the inflation experience of older Americans whose spending basket weighted toward healthcare and housing has historically inflated faster than the general consumer price index used to calculate adjustments. Now let's talk about what to do, not from fear, not from certainty about any particular outcome, but from the disciplined, balanced, first principles approach that allows a family to navigate a range of economic environments without making a concentrated bet on any single scenario. Before going further, what follows are principles and categories of thinking, not personalized recommendations. Every individual's situation, income, time horizon, tax position, existing assets, and risk tolerance is different. The goal here is to help you ask better questions and think more clearly, ideally in conversation with an advisor who understands these dynamics. The first principle is to understand your current exposure. Before any transaction, do an honest assessment. How much of your wealth is in cash and short term instruments? How much is in bonds and fixed income? How much is in equities? How much is in real assets, real estate, commodities, inflation linked securities? For many conservative savers who have followed conventional pre retirement guidance, the answer tends to be heavily weighted toward cash and fixed income, lightly positioned in real assets. That portfolio construction was sensible during the long disinflationary era. It carries meaningful risk in an environment where inflation runs persistently above what fixed income yields can compensate for. Understanding your current position is the necessary first step before deciding what, if anything, to change. The second principle is to diversify across asset classes that respond differently to inflation. The core idea here is balance, not a bet on inflation, but a portfolio that does not lose catastrophically in an inflationary environment while still participating in non inflationary growth. Assets that have historically provided meaningful inflation protection include equities in companies with genuine pricing power, businesses that can raise prices when their input costs rise, maintaining real profitability across different inflation regimes. Real estate, particularly owner occupied housing or income producing property, over time, nominal real estate values tend to track inflation. Fixed rate mortgage debt becomes progressively less burdensome in real terms as inflation rises. Treasury inflation protected securities, or TIPS, government bonds, whose principal adjusts upward with the CPI, providing a direct inflation linkage within the fixed income allocation. And commodities and commodity linked equities, raw materials, energy, and mining companies whose revenues tend to rise with inflation. The right allocation depends entirely on individual circumstances, income needs, time horizon, existing assets, tax situation, and risk tolerance. But the principle is clear. Concentration in any single asset class, especially nominal fixed income, is the most direct source of inflation vulnerability for most conservative savers. The third principle is to be thoughtful about the structure of your debt. In an inflationary environment, not all debt is equally problematic or even problematic at all. Fixed rate debt at interest rates below the inflation rate is, in real terms, advantageous for the borrower. You repay with dollars that are worth less than the dollars you borrowed. This is why homeowners who locked in mortgage rates at 2 or 3% in 2020 and 2021 found themselves in an unexpectedly strong position as inflation rose. Variable rate debt is the opposite. When inflation rises, interest rates typically rise with it, and variable rate obligations increase your monthly burden precisely when everything else is also costing more. If you carry variable rate debt, adjustable mortgages, credit card balances, certain lines of credit, reducing or eliminating it is a meaningful protective step. The fourth principle is to build income streams that can adjust to economic conditions. The most inflation resistant retirement income is income that can grow over time rather than remaining fixed in nominal terms. Social Security, imperfect cost of living adjustments, and all is more inflation protective than a fixed pension with no adjustment. Rental income from real estate tends to rise with inflation over time, at least over multi year horizons. Dividends from equities in companies with pricing power and a history of dividend growth can provide income that at least partially tracks economic conditions. The goal is not to eliminate all fixed income. It plays a real role in a balanced portfolio. The goal is to ensure that not all of your income is fixed in nominal terms and that some meaningful portion can adapt as the economic environment changes. The fifth principle is to stay educated and remain adaptable. Perhaps the most important principle of all is also the least transactional. The families that navigate economic transitions most successfully are not always the wealthiest or the most financially sophisticated. They are the ones who remain curious, who continue learning, and who are willing to update their assumptions when evidence changes. The most dangerous financial position is not a particular asset allocation. It is the fixed assumption that conditions will remain as they have been. The low inflation world of the past 40 years felt permanent to those living in it. The high inflation world of the 1970s, before that, had felt like a permanent new normal to those living through it. Neither was permanent, and the conditions of today will not be either. Staying educated, understanding the forces at work, tracking how they evolve, and making measured adjustments as the evidence warrants is not a complex or expensive undertaking. It is a habit. And over long periods, it compounds. Gold deserves specific attention because it is perhaps the most misunderstood asset in the context of inflation protection. Gold does not pay interest, it does not produce dividends. As a pure growth investment, it has substantially underperformed equities over most long term measurement periods. So, why does it appear in serious, carefully constructed portfolios? Because gold is not primarily a growth asset. It is a store of value and one with a long track record across recorded human commerce. Across many of the significant episodes in history where currencies were substantially debased, gold has tended to hold its purchasing power over the relevant time horizon, not in straight lines, not without extended periods of underperformance, and not as a guarantee of any specific outcome, but with enough consistency across enough distinct historical cycles to earn a role in how central banks, sovereign wealth funds, and serious long horizon investors think about monetary risk. This is why central banks around the world, including many with recent experience of currency crises, continue to hold gold as a reserve asset, not because they expect imminent financial catastrophe, but because in a world of competing fiat currencies and sovereign debt pressures, gold represents a claim on value that is not simultaneously someone else's liability. For families approaching or in retirement, a modest gold allocation treated as insurance rather than a primary strategy can provide some buffer against scenarios where monetary conditions deteriorate more than the consensus expects. You do not need the house to burn down for insurance to be a rational purchase. The uncertainty of the outcome is precisely why you hold it. Not all families face the same inflation exposure. Understanding where you sit on the vulnerability spectrum is important for calibrating your response. Families who are already retired and living primarily on fixed income pensions without inflation adjustments, bond income, and cash savings tend to be among the most directly exposed. Their income is relatively fixed. Their expenses rise. The gap compounds annually. Families in the 5 to 10 years before their planned retirement date face a related but distinct risk. The years immediately surrounding the transition into retirement are financially among the most consequential. A sustained period of elevated inflation in those years, particularly if combined with weak asset returns, can meaningfully alter the long run trajectory of a retirement plan. This is sometimes called sequence of returns risk. And an inflationary environment adds a second dimension to it, not just the risk of assets declining, but the risk of living costs rising at the same time. Families with significant real assets alongside their financial savings, owner occupied real estate, a small business, equity in productive assets tend to be more naturally resilient because some portion of their wealth is already linked to the real economy rather than fixed in nominal terms. The common thread is not wealth level, it is the composition of wealth and income. A family with modest total assets but diversified across real and nominal holdings may navigate inflation better than a larger portfolio concentrated entirely in cash and bonds. Composition, not size, is the critical variable. A natural question at this point is, couldn't the Federal Reserve simply raise rates again if inflation reaccelerates? In principle, yes. In practice, the constraints are more complex than they were in previous cycles. With the federal debt approaching $39 trillion and annual interest costs nearing $1 trillion even at current rates, a sharp increase in rates generates a rapid and significant escalation of the government's borrowing costs. A meaningful portion of outstanding Treasury debt matures and must be refinanced each year, and refinancing at higher rates compounds the fiscal pressure quickly. This does not mean the Federal Reserve is powerless. It is not. It means the practical range within which rates can move and the duration for which elevated rates can be sustained may be more limited in the current environment than it was when Paul Volcker raised them above 20% in 1980. The government's own balance sheet has become a factor that monetary policymakers must weigh in ways that simply did not apply in earlier inflationary episodes. The likely outcome in a scenario of reaccelerating inflation is probably not a full capitulation by the Fed, but it may be a policy stance that is somewhat less aggressive than the inflation situation would optimally require, resulting in inflation that is brought down but perhaps not fully to target, persisting at modestly elevated levels for an extended period. Compounded over years, that difference matters enormously for families whose financial plans assume 2% inflation and are instead experiencing 4 or 5. Let me close with what I believe is the most important takeaway from everything we have examined today. Throughout all of history, across different empires, different monetary systems, different political structures, the families and individuals who have navigated periods of monetary disorder most successfully have shared one common characteristic: not wealth, not access to privileged information, not the ability to predict the future. They shared clarity about what they did not know, combined with disciplined preparation for a range of outcomes. They did not bet everything on one scenario. They did not assume that recent conditions were permanent. They looked at the structural realities of their moment with honest eyes, acknowledged the risks those realities implied, and built portfolios and habits that could navigate different conditions without requiring any single outcome to be correct. That approach has a name in risk management. It is called balance. Not the absence of risk, not the pretense of certainty, but the deliberate construction of a position that does not fail catastrophically under any single foreseeable scenario, and that is positioned to benefit when certain less expected scenarios materialize. The greatest financial danger facing most conservative savers today is not inflation itself. It is the unexamined assumption that the conditions of the recent past will continue indefinitely. The assumption that because inflation was low for 40 years, it will remain low. The assumption that because the Federal Reserve defeated inflation once with tools and conditions that no longer fully apply, it can do so again with equivalent effectiveness. The assumption that financial plans designed for a 2% inflation world remain optimal in a world where structural forces are pushing in a different direction. Assumptions are not facts. And when assumptions go unexamined long enough, they stop feeling like assumptions. They start feeling like reality. The work, the honest, patient, necessary work is to surface those assumptions, to examine them in the light of historical evidence and structural analysis, and to ask, do these still hold? If you observe with care, the pattern across history is consistent. Governments carrying large debts have, across many different eras and mechanisms, found ways to reduce the real burden of those debts over time through inflation, through financial repression, through low real interest rates, sometimes through restructuring, savers holding fixed nominal claims during those periods have to varying degrees been on the receiving end of that adjustment. And the families that prepared, who diversified across real and nominal assets, who thought carefully about which income streams could adapt and which were fixed, who understood the cycle they were living through, those families emerged from periods of monetary adjustment not just intact, but in many cases in a stronger relative position than their peers who were not paying attention. That preparation is available to you, not certainty, not guaranteed outcomes, not a prediction about what inflation will do next year, but the clear eyed, balanced, first principles positioning that gives you the best possible chance of navigating whatever comes next, regardless of which specific scenario plays out. The history has been offering the same lessons for centuries. Cannot predict the storm, but you can build the kind of structure that does not depend on the forecast to hold.